Every single day, trillions of dollars move through the stock market. People buy and sell pieces of companies worth billions of dollars, sometimes making fortunes, and sometimes losing everything. So today, we are going to break down the stock market from the ground up. But here is the surprising part. Most people don't actually understand how the stock market works. Many people imagine a giant room full of traders shouting and waving papers. Today, the stock market is completely different. The stock market is basically a huge digital marketplace where people buy and sell ownership of companies. Instead of one person owning the entire company, ownership is divided into millions of tiny pieces. Those tiny pieces are called stocks or shares. When you buy a stock, you are not just buying a number on a screen. Imagine a company is worth $1 million. The owners decide to divide the company into 1 million pieces. You are buying a small piece of a real business. You become a shareholder. If you buy one share, you own a very small part of that company. Does owning one share mean I can walk into the company's office and tell the CEO what to do? So why would a company sell parts of itself? The answer is simple: money. Companies need money to grow. Companies need money to build factories, hire employees, and create new products. When a company first sells shares to the public, it is called an initial public offering, or IPO. Open offices, hire employees, create new products. Now comes the question everyone wants to know. Why do stock prices change every second? When demand increases, the price usually goes up. When more people are selling than buying, the price usually falls. The answer comes down to one simple concept: supply and demand. Company profits, interest rates, economic conditions, and new technology can affect stock prices. The stock market is not only about numbers, it is also about human psychology. Global events can also affect the market. The stock market changes because millions of people are constantly deciding what companies are worth. There are two main ways investors make money from stocks: buying a stock at a lower price and selling it later at a higher price. You buy a stock for $50. Years later, the stock is worth $100. Some companies share part of their profits with investors. These payments are called dividends. Investors can make money from company growth and from receiving payments. If the stock market can create wealth, why do so many people lose money? The first mistake: trying to get rich quickly. When prices fall, they panic and sell. This is why many investors choose diversification. Another mistake is putting all your money into one company. You have probably heard names like the S&P 500, the NASDAQ, and the Dow Jones. The goal is not to predict the future perfectly. The goal is to build a strategy that works over time. They are simply groups of companies used to measure how parts of the market are performing. For example, the S&P 500 follows hundreds of large American companies. Many investors choose to invest for the long term. Over time, small investments can become much larger. When people say the market went up today, but the basic idea is actually simple. The earlier you understand how it works, the better decisions you can make. The stock market can seem complicated. If you want to understand how money really works, subscribe.